Lecture 7. In this lecture, we cover two topics. First, reporting and analyzing liabilities. Then we talk about stockholders' equity. First, we have current liabilities. They're short-term in nature. Typically, they deal within 1 year. But there are some exceptions for those industries with really long operating cycles, like shipbuilding industry. Their current liabilities may be longer than 1 year, but for most companies, yes, deal within 1 year. That's a threshold for current liabilities. So we have two types of current liabilities. We have current operating liabilities and then non-operating liabilities. For operating liabilities, we have accounts payables. When we purchase on account, we have to pay vendors. These are the operating liabilities. Accrued liabilities like salary payables to employees. Then we have deferred performance liabilities. These are the obligations we have to satisfy before we can recognize revenues. And non-operating liabilities include, for example, short-term interest-bearing debt, and then we have the current maturity of long-term debt. Okay, long-term debt is not a current liability, but it has some part of it that are going to mature very soon. It's a current maturity. For example, mortgage is a long-term debt, but the next month's payment, is a short-term liabilities. It's a current maturity of a long-term mortgage. So most of these things is going to incur an expense, at the same time. So it's going to affect our income statement. Right here we have an example of Verizon's current liabilities. Right, it has debt maturing within 1 year, account payables, and accrued liabilities. Now, this is the most significant part of these current liabilities. Also have the current operating lease liabilities and other. Recording current liabilities. Now we have seen these journal entries already. For example, the company purchased merchandise $800 on account, which means they're not going to pay cash yet. They're going to pay later. So we debit inventories and in credit increase liabilities, account payables, $800. So next journal entry, a transaction is companies sold inventory. And we know to record a selling of inventory, right, we need two journal entries, right? This journal entry is on the revenue side, followed by a journal entry on the cost side, right? Next, we're gonna receive payment from customers. So we debit cash, credit account receivables. And finally, we're going to pay our vendors. So we debit account payables, reduce our liabilities, and credit cash, reducing our cash. As you can see, this company has a pretty good the purchase and the sale terms. See, they can purchase inventories on account. They're going to sell to customers. They receive cash quickly from customers. And finally, they pay vendors, which is very good. Typically, for these type of company, you don't have to have a lot of cash to start a business, right? You can start business with nothing. I think Apple has these kind of priorities. Apple, if you check their purchase and sales terms, and typically if they purchase stuff from vendors, they're going to pay them really late, but they're going to collect cash from customers very quickly. So what is the result of increasing account payables? First of all, if you can notice, we have a decrease in our net working capital, Remember, working capital is current assets less current liabilities. When current liabilities increases, right, net working capital will decrease. Right, reducing in working capital could be a good thing, right? Because which means you have to have fewer capital to sustain your operations. But if you have too little working capitals, it could be dangerous, risky. It means you may have liquidity issues if you have too little working capital. And increasing account payable is going to increase our cash flows. And we have seen that in the cash flow chapters. And as a result, we may see increase in our profitability. Okay. Very likely, there's reduction in the level of interest-bearing debt. Right? If we can pay our vendors late, okay, it's like a interest-free loan from vendors. So we can borrow less from banks. So our profitability will increase. Right, accrued liabilities. These are the liabilities and expenses incurred during the period but not have been paid yet. Often they are referred to accrued expenses. Right? For example, if we haven't paid our employees, right, we're going to have wage and salary accrued payables, right? We may have rent payables, utility payables, but all the expenses have incurred already. Right, accounting for accruals, typically we're going to increase debit and expense and credit liability. Now this creates opportunities for managers to shift incomes. If I accrue less liabilities in this period, for example, right, I recognize less salary and wage payable to employees this period, I underestimate this period's liabilities. So at the same time, I record less salary and wage expenses. So I overestimate income and overestimate retained earnings as a consequence. Right, so be careful about these accrued liabilities. So here is an example of wages. So if we accrued wages $300, we debit wages expense and credit wages and payables. And when we pay, we just debit, right? Reduce the liabilities and the credit cash. It's very simple for journal entries. Now let's talk about contingent liabilities. Contingent liabilities are liabilities in uncertainty. Okay? There are several criteria before we can recognize as contingent liabilities. First, the potential obligation must be probable. Okay, the probable means likely, very likely. And the amount must be reasonably estimated. Example of contingent liabilities like warranty claims. So it's very likely, right, some customers will come back asking for repair. That's warranty claims that become our liabilities. Or it is a lawsuit going on, very likely, right, we're going to lose a case and pay something. And if that is the case, we're going to recognize a liability. That is contingent liability and an expense. Right, if either of these conditions are not met, for example, obligations that are reasonably possible, it's not probable, so the probability is less. Okay, so we don't have to accrue, but we're going to disclose the information in the financial statement, in the footnote. Right? If the obligation, the probability is extremely small, we can ignore it. Okay, we can ignore it. An example of contingent liabilities is warranties. Warranties. Right, to record the contingent liabilities, we're gonna estimate the cost of this commitment at the time of sales. Okay, at the time of sales. So the warranty may be effective for 3 years, 3 years factual warranties. All the 3 years warranties should be recognized in the year of sales. So we're going to estimate the obligations as a liabilities and expense in the period of sales. And at the time of the repair or replacement is taken, there's no more expense, but warranty liabilities is decreased. Okay, here we have an example of warranty. So the company estimate warranty liabilities for current period sales, $2,000. Okay, that covers all the factual warranty related to this year's sales. To a debit warranty expense and a credit warranty payable. Okay, then later, $400 repairing under warranties. Okay, the company is going to pay cash, but there's no more expense because all the expense has been recognized in the year of sales. So debit warranty payables and the credit cash. Typically, those warranties will be disclosed in the footnote. Right, we're going to begin with some contingent liabilities. If we fix or repair customers' warranties, right, it's going to reduce, and it's going to increase our warranties. If we have new sales, increase warranties, so we're going to have ending warranty liabilities. Okay, these refers to the factual warranties. But there's also a warranty could be sold by the seller, or could be sold by third party. Those warranties are sales. Okay, could view those warranties as under revenue. Okay, under revenue. So, for example, you purchase vehicle, come with a 3-year factual warranty. Okay, so the dealer offers you an additional 5-year extended warranty. So it's extended warranty, you pay for it, become earned revenue for the dealer. Okay, earned revenue. So once you claim the warranty under the contract, the dealer is going to recognize revenue, service revenue from the warranty contract. Okay, non-operating current liabilities, typically they're financial liabilities. Okay, they include short-term bank loans, right? Accrual of interest of those loans, and current maturity of long-term debt. So how do we use financial liabilities? Typically, the strategy we adopt is the current assets are typically financed with current liabilities, and then long-term assets are typically financed with long-term liabilities. Right, I can borrow a short-term loan to increase my working capital, but if I want to purchase a building, something like that, long-term loans will be obtained. So typically the current financial liabilities are used for seasonal considerations For example, if we sales in hot seasons, like in summer seasons, right? We have a lot of sales. We need to increase our inventories, and these are the seasonal fluctuations. In those months, financial needs will be considered, especially short-term, current financial liabilities will be considered for those seasons. Now, when typical short current financial liabilities are short-term interest-bearing debt, typically they are in the form of a bank line of credit. These are the bank's commitment to lend up to a given amount to the company. So if you borrow within the line of credit, right, they're going to give you the loan easily. Those are interest-bearing note typically, right? If you have those, you borrow, you have increase of current liabilities. Interest is accrued, okay? Interest is accrued, and incur interest payables. So how do we calculate interest? Interest expense equals, right, the principal, borrowing amount multiplied by annual rate, and multiplied by portion of the year outstanding, or time factor. Alright, here examples. Borrow $3,000, 6% annual rate. Okay, all interest rate should be expressed as annual rate. From January 1st, interest payable on the first day of each quarter. So we're paid April, July, October, and next year January 1st. So when we borrow, there's no effect on income statement. Right, we debit cash and credit notes payable for now. However, we're going to accrue interest at the March 31st, at the end of first quarter. So how many months we have borrowed? January, February, March. 3 months. We have borrowed for 3 months. Okay, therefore the calculation of the liabilities, interest owed, is 3,000 multiplied by 6%. Right, that's the annual rate. Right, that's annual rate. Annual rate, it's one annual rate, right? How much is 180? But we're gonna have a quarter's interest that's divided by 4, so we have $45. So a debit interest expense 45, credit interest payables 45. Remember, we don't have to pay for now because the first payment were made on April 1st, the next day, April 1st. So by the end of the first quarter, we report expense and liabilities. Then the next day, April 1st, we're going to just pay the interest, debit interest payables, and a credit cash. Right, finally, we have current maturity of long-term debt. We explained that mortgage payment, right, is a long-term debt, but next month's mortgage payment is a current liabilities. Typically, these are the payments must be made during the upcoming 12 months on a long-term debt will be viewed as current maturities. Unless we have a financing activities or financing plans, refinancing plans for those maturities, okay, typically they will be reported as current liabilities. However, if we have refinancing plans or activities, okay, they remain as long-term liabilities on the balance sheet.